The liquidity map. On August 5th, 2024, the yen carry trade unwind collided with US recession fears, Bank of Japan rate shock, and a crowded global positioning. The result was a cross-asset liquidation event. The Nikkei fell 12.4% in a single trading session, its worst day since Black Friday in 1987. Over $790 billion were wiped from Japanese stocks. Bitcoin fell from $61,000 to less than $49,000 within 24 hours, and more than $1 billion worth of crypto positions were liquidated. If you were watching the price chart on that day, you would have seen humongous red candles, a long red wick, a violent drop, and only a partial recovery. But the candle was the visible outcome. Underneath it, funding rates were shifting, leverage was being forced out, order book depth was collapsing, market makers were protecting their inventory, and large flows were being routed through venues most retail investors have never heard of. This video is about the gap between the market you see and the market that actually clears. Because the price on the chart is not the whole story, it's the output of the system. The funding, the leverage, the order book depth, the OTC flows, the dealer behavior underneath the machinery, that's what actually produces the price. By the end of this video, you'll understand where the machinery lives and why it matters. This is a liquidity map. First thing to understand is there is not one market, there are two. We have the spot market where you buy the actual asset, and we have the derivatives market. This is where you trade contracts based on the price of an asset, but not the asset itself. In modern crypto markets, the derivatives market absolutely dwarfs the spot market in volume. And you've probably heard of it, the primary instrument is called a perpetual future. A normal futures contract has an expiry date. A perpetual contract does not, hence the name. This creates a problem. Because there's no expiry forcing the contract back to actual spot price, there needs to be something to stop it from drifting away. The answer is the funding rate. The funding rate is a small payment that changes hands between people longing and shorting. When the crowd is long, people longing need to pay people who are short. And same for the opposite. When the crowd is short, those who are short need to pay the people long. This is the actual mechanism that keeps the perpetual price connected to the spot price. And the payment is very useful because it gives you a great idea of where the crowd is at. Are they long or are they short? When funding is positive and stays positive, traders are leaning long and they're paying a lot to hold their position. They've got a lot of conviction. This over time can create over leveraged markets. We saw this in November 2021 around the cycle peak. Long positioning was very crowded. You had a lot of traders paying a big premium to stay in their positions. This put the market in an incredibly vulnerable position and a cascade ensued. In the opposite direction, when funding goes deeply negative, traders are betting on lower prices. This can often signal capitulation. We saw this with the fall of FTX. As funding ran deeply negative, it actually forced people to sell. People weren't just closing voluntarily, they were forced to close positions involuntarily. The bearish positioning became extreme. Funding isn't a buy or sell signal, but it is a temperature reading. It gives you a great idea of what type of regime you're in. The OTC market. Now, here's a part that surprises a lot of people. If you tried to buy $5 million worth of Bitcoin in a single transaction on an exchange, you would move the price against yourself. This is because the order book is much thinner than it appears. You're trying to buy $5 million worth of Bitcoin, but there may only be a few hundred thousand available at the price you're looking at on screen. So as you go in to buy your position, you're actually pushing the price up and you're forced to buy the volume that is for sale at the higher price point. By the end of it, you've paid way more than you thought you would. So as you can imagine, big players and institutions can't do that. So instead, they use a different channel, something called over-the-counter or OTC for short. Think of it like buying a house. You don't just walk into a real estate agent and say, hey, here's $5 million, I want to buy a house. There's a process. These type of large, illiquid transactions have to happen privately. OTC desks like Galaxy, Cumberland, and B2C2 do exactly that for crypto. They quote a price for the whole block and a transaction happens privately. So instead of going to the public market and swapping, people transfer between wallets. So it's not recorded as a sale, but it is still being transferred. Over time, the desk slowly manages the position, hedging in the open market, slowly exiting or entering. So the visible trade doesn't hit the market right away. It can sometimes be spread over a few days or even a few weeks. And this is incredibly important for understanding market structure, because most of the big capital moving the markets is happening in this way. It's not happening through Binance and Coinbase. It's negotiated through OTC desks, internalized by liquidity providers, or worked into the market over time. So the next time you hear someone talking about the public order book, just remind them that that's only a part of the picture. There is much more beneath the surface. This is exactly why on-chain analysis has become such a big business. Firms like Glassnode, Arkham, and Nansen have built entire companies around tracking wallet actions. Because when a lot of real activity is happening off the books, the blockchain becomes that window into the action. Market maker inventory. Okay, the next layer lives inside the visible market, but most traders and investors skip right past it. Meet market makers. Market makers are firms who provide constant buy and sell quotes to the market. That way, when you go to buy, there's always someone willing to sell, and when you're looking to sell, there's always someone willing to buy. In exchange, market makers are taking on the inventory risk. They're holding an asset that, hey, at any point can lose demand, and there's no one interested in buying and no one interested in selling. Think of a bookmaker. When a bookmaker has taken too many bets on one side, they need to adjust the odds to make the other side more appealing. Market makers are essentially doing this with the price of an asset. So when lots of people are buying, they eventually offset it by selling to make it more attractive again, and vice versa. The issue is when a market maker accumulates so much of a particular asset, they can get shaky. The risk is gone up, and it puts them in a position where they need to start to sell to de-risk. Now, in some cases, we've seen market makers completely dump assets and send charts crashing to zero. And of course, if they hold a lot of capital, they can go in and they can buy huge sums of a given token spiking price. There's a lot of market manipulation happening in this world, but there are some serious above board players who are doing this correctly, because it is a service needed. There does need to be buyers and sellers to make a market work. It just depends who is pulling the strings underneath it. Let's take a look at an example. May 19th, 2021. Bitcoin fell from around 43,000 to 30,000. During crashes like that, you can see liquidity get sucked up immediately. The depth that looked available under calm conditions disappeared as soon as things became distressed. The cushion that would normally absorb sell pressure can evaporate, and price impact becomes much larger. To firms watching order book depth and liquidity conditions, that fragility may have been visible before it was reflected in the price chart. To everyone else, it looked like it came out of nowhere. But those who are informed and paying attention knew exactly where things were about to go. At this point, retail is watching price. Professionals are watching order book, the funding, the OTC flow, and the inventory behind it. The price is simply the output of all of these forces. You can think of it like the smoke, but not the fire itself. Why buying the dip is harder than it looks. Now, let's tie all of this together. And in doing so, we're going to change the way you think about one of the most common statements in all of crypto. You've probably had a lot of people tell you to buy the dip. Now, the issue is the logic behind buy the dip assumes that when price falls, you can step in and buy at the lower price. It assumes that the liquidity is there waiting for you. But in a real capitulation event, that assumption breaks. When the market's crashing hard, the providers of liquidity pull back at the same time. Market makers widen their spread to protect themselves. OTC desks demand larger discounts. The depth in the order book starts to thin out. So you think you're going to step in, buy the dip, and price recovers, but it's not that clean. The price can continue to dip, and it's not because it's suddenly worth less, but it's because the liquidity itself has been impaired, and the market just simply cannot absorb the supply without impacting price. And here's the asymmetry that most people don't think about. In those scenarios, there are two participants, those supplying liquidity and those absorbing it. A professional desk may be well positioned as a liquidity provider. They're quoting a price to a desperate seller, and as they say, beggars can't be choosers. And because liquidity is scarce and risky to provide in that moment, they can afford to charge a premium. Then we have a retail trader who is using market orders in a fast-moving book. They're usually consuming liquidity. They're crossing wide spreads, getting filled at worse prices, things that are shown on screen but then completely different in actuality, taking whatever liquidity they can get. Both are technically buying the same dip, but the economics are completely different. One is being paid to provide liquidity and the other one is paying dearly to consume it. This is why institutional execution frameworks tend to emphasize patience, working orders slowly, providing liquidity rather than chasing it. All of this comes back to August 2024. What made it such a great example was the speed. A full liquidity shock from crowded positioning to forced deleveraging and partial stabilization compressed into roughly a single trading session. Funding flipped, the basis cratered, liquidity vanished and slowly returned. Every layer of the liquidity map moved at once. Retail saw a scary candle on the chart. So that's the liquidity map. Spot and perpetual markets are linked by funding, and funding tells you where position pressure is building. OTC desks explain why a lot of institutional flows never appear on the order book. Market maker behavior can often explain why liquidity can vanish exactly when it's needed most. And a real crash reveals the difference between those providing liquidity and consuming it. The retail framework watches the candle. The institutional framework studies what produces the candle. The data to do this is more available than it's ever been. Funding rates, open interests, order books, exchange flows, stablecoin flows, liquidation maps, all of it is accessible. But what's very rare is the literacy it takes to actually read and interpret it. The edge is not having the data, it's knowing how to read it. That was the liquidity map. Thank you for watching.